About the value of this as a story. If you look at the delta buckets on oil through the hours, you'll see that $3.46, 428, 456, 470, 670, 750, and this is the current one right here at 750. This is at 2 o'clock. So you can see it's getting very expensive to buy oil, and that's obviously leading us to that very bullish view that the market is going to be going up. Now, we've got to try and understand why this is the case. Is it just a series of numbers that don't mean anything? So instead of me talking about something that glazes people's eyes over, it's quite important that we understand what it is I'm talking about. So why I've been able to be buy-side oil so much. In the world of trading, there's a lot of different algorithms at work, but one of the algorithms that is constantly on the go, 100% of the time, basically 24 hours a day if it could be, is what they call the delta neutral algorithm. Okay, so when we're talking about deltas, we're talking about hedging. The idea of delta neutrals means that there is no directional exposure. So this is a hedge concept. So this algo, excuse me, this algo is active all the time. It's not active at bottom edges. It's not active at top edges. It's active on every single price right through the entire day. Now, why is that the case? Well, for example, if I've got exposure, so what would the exposure? Say I've sold a call option. So I've got an exposure of minus 100 shares, correct? It's currently, the option, of course, I'm looking at is perhaps at the money, makes no difference. And at the money option usually has a delta of 0.5, right? So in other words, that's my exposure. So for me to hedge that exposure, if the delta was 1.0, every dollar that the shares moved up in price, I would lose how much? I would lose $1 on my option, correct? I would lose exactly $1 on my option. Do you agree with that? So in other words, if I want to hedge that position, I would need to buy 100 shares. If I buy 100 shares with a delta of 1.0, my upside exposure is 0. Correct? Do you agree with that? Okay, so delta is part of the pricing mechanism. Okay, so the price you pay for delta is part of the pricing mechanism. Of course, it's part of the option pricing. And it's contained in the various formulas, and obviously Black-Scholes is the most famous, but there's plenty of different other option formulas that's used as well that prices up different things from implied volatility elements. So obviously, if I was in this situation above, and the delta is 0.5, well, I've got to buy, for example, I've got to buy just 50 shares, right? So that gets me zero exposure. That gets me zero exposure, and this is what's called delta hedging. Now, if the formula changes, and instead of having a delta of 0.5, the price of that delta changes to, say, 0.7. Why would it change to 0.7? Perhaps they expect it, they expect maybe the price hasn't moved yet, right? So this is basically the idea that the price hasn't moved yet. They're now expecting stronger upside movement. They're now expecting a stronger upside movement. So the call option is going to be more expensive, correct? So therefore, what I've got to now do, I've got to buy an additional 20 shares. To bring my delta to zero. And that way I'm fully covered again should the price rise, right? I'm now fully covered. Now, if it drops from 0.7 back to 0.5, I can sell those shares, can't I? I don't need to keep hold of those shares. At the monies, we're always backwards and forwards. So a lot of the times, the way that institutions price this, they price the 25 delta buckets. When I say the 25 delta buckets, so in other words, they take a couple of strikes before, a couple of strikes after, and they price a bucket of strikes. A lot of the times you'll see it's quoted as the 25 RR. It's not the same as the option strategy called the 25 risk reversal. It is just basically a delta bucket of the 25 risk reversal. So in other words, the 25 delta calls and the 25 delta puts, right? And it's the difference between the price of the 25 calls minus the puts. So in other words, if I was to draw this out as a simple pricing matrix, and this is the at the money, just at this price here, then of course, as you go higher, you're out of the money. And that's probably going to be approximately where the 25 call is, right? So you'll see this as 25C, and usually there will be a price beside it if you're getting a quote. And then you'll see this here as the 25P, and you'll see a strike price associated with that as well. Usually you'll see, so for example, you'll see 25P and, that 10, for example, behind that, and that 10 is the price, the strike price. But just 25P, 25 call. Let's assume in scenario one, like oil, that we've got a bit of a skew going on. So in the beginning of the overnight session, the oil calls were 670, right? 670. You see that? 670, and the puts were 3. Okay? 670, the puts were 3. So obviously, one of the things that you can start looking at is the difference about how these change. So in other words, if you've got a very expensive call and you've not so expensive put, then of course that becomes what's called the market skew. You've all heard of the word skew. That's called the market skew. So in other words, the 25 risk reversals equals the skew at that price. So it's not as complicated as you think it is. So that's why you shouldn't roll your eyes at this, because it's not that complicated. It's just where you're taking your measurement for. That's all it is. Nothing special about the 25s. It's just where you're taking your measurement from. So obviously, depending upon what happens. So for example, say the put options become very cheap in scenario number 2, and the call options get very expensive, and you get something that looks like that, then obviously this is very bullish market, isn't it? This has become a very bullish market. So obviously what's happening is we are measuring the change. Now, a lot of times the put options don't go down in price. Because volatility is rising, the put options actually go up in price. It's still the 25 delta puts, but the volatility is increasing. So the puts generally will go up in price as well if volatility is growing. But that's not what we're looking at. We're looking at the skew. So what normally happens is that this goes up parallel to the upside, but the skew changes. Obviously, in this skew, you should be doing one thing and one thing only. As Paul would put it, buy, right? So you're just going to buy a lot of stuff in that type of situation. Well, that's what we've seen on the oil. If you look at how I've labeled this, I've just simply colored it green from last night. Take a look. So this is oil. You see how it's green at 10 o'clock and green at 11 o'clock and green at 12 o'clock and green at 1300 hours and green at 1400 hours? See that? It's just green. In other words, you should be buy side only oil for the entire run through this. Now, obviously, interestingly enough, RBOB was also very green. Look at RBOB, the difference, 10.75. Oil was 4.56, right? So massive difference between the RBOB and the oil. So when we think about how this thing eventually evolved, I'm looking at the changes, the point changes, the percentage changes, the total number. The total number is bullish or bearish, but also the change is bullish or bearish. So we can obviously understand a lot about what's going on here. So I'm looking at oil today and I'm saying to myself, wow, this is mega bullish. Mega bullish. And this is what's happened since then. And the guys in the room, interestingly enough, will know this because I talked about this morning with them in the classroom. This morning at 11 o'clock. I says, be very aware that 25 delta, which we've just been talking about there, is very bullish oil. At the time oil was trading in here, $86 approximately. It's now trading $87.30 since I made that suggestion to you. So it's went up $1,000 since I talked to you guys about it. Is that not powerful information that should be in the backdrop of your charts? That knowledge should be in the backdrop of your screens. Should be, absolutely, shouldn't it? So when you see it, it's not there for just making it sound like you know what you're thinking or you know what you're talking about. It's there because it actually can serve a real money purpose. A real money purpose to show you that there's real advantages to knowing this stuff. Our algorithms do the 25 delta hedge. So this is how we know about it, because the algorithms always adjust to make the market delta neutral, the hedging delta neutral. You don't have to make the market delta neutral. And I've often suggested to the desks, not very successfully, to the guys upstairs, why don't we, when we're getting a big move on delta, why don't we leave some delta exposure available and make some more money? But no, that's not hedging properly. That they say basically, and they're right, as you would imagine, they're right to say it. That means that we're basically just taking the book and we're taking it into a directional bet in the marketplace. And I'm like, yes. Well, that's not our job, is it? Is it, Ray? That's not our job. Well, should it not be our job of making more money? Yeah, that's not interested. They just want their hedge. They just want their hedge in place. It's not their business plan. It's not their business model. They just want to make sure they've got their hedge in place. Fair enough. Tis what it is. But they could have made a lot of money. And this is why we've suggested that we want to take another second look at this project. We'll certainly speak to all the guys in the trading world in terms of Colin and Greg, David, and see if anybody's got any views on how to get that information into your Sierra charts or your Ninja Trader. But it's a brilliant trade, of course. It is a brilliant trade. So we did have it in the Sierra charts before, by the way, live. And but the data cost money, and there wasn't an awful lot of interest for David. There's very few people said that they were interested, and it was clumsy in those days, the way that the data had to be sent to Excel spreadsheets and then posted from Excel into Sierra charts. It was very, very clumsy, and I think it just became a bit of a headache for David to do. So I think the project was just pushed to the sidelines. And I think the guys were right this morning that it was perhaps a little bit too advanced for everybody at that stage. And at that stage, of course, that's absolutely do-dandy. I can understand that fully. But if you've got access to real-time option data, then of course you can do your own. You can actually do your own calculations, or you can watch it live. In fact, you probably can chart it live on some of these retail platforms, I'm sure. So it might be something that you can pay attention to.